Hey YouTube, this is Zach with Achilles Financial. Today we're going to be talking about CPI and core CPI, which comes out this Thursday, June 10th. So right now I'm showing on my screen TD Ameritrade, and if you scroll down from their main screen, you have the option to showcase various news, watch list, as well as calendar. So what we're going to be looking at here, just kind of as we go through this, is normally this is what I use to look at the earnings that are being announced on any given day. For today, I am going to be looking at the economic events. If you are interested in ever using TD Ameritrade, even if that's not your primary platform, I would heavily encourage you to do so because it is, in my opinion, the best trading platform utilizing their Thinkorswim, as well as their best research platform that's out there because it offers a ton of information about individual companies and incurring news associated with them. So today we're going to be talking about CPI because CPI has been heavily influential in determining what we expect going forward associated with bond rates, because if we believe that there is going to be a lot of inflation, we anticipate that bond rates will rise because no one wants to pay 1% for an item that's going to take 10 years to mature, and if they believe that inflation is going to be much higher than that. The other piece of this is, generally speaking, when we see that rotation into bonds or when we believe that there is a high inflation environment, people are a lot less willing to invest into growth commodities because they believe that, again, you are monetizing that debt, which can basically change how that debt is viewed. And we actually see more so a rotation into value stocks. And we saw a lot of this past February when the bond rates actually went up to about the 125 to 150 time period over the 10-year yield over about a 2-week time period. And so that's when we saw the massive correction in tech stocks back in February of this year, 2021. So let's take a look at the CPI and what that is inclusive of. So as we often do, I am utilizing the CPI index or consumer price index on the FRED database. This is the Federal Reserve Bank of St. Louis is who creates FRED, and it tracks a lot of economic data, and this is super important to have the capability to look at. What we're looking at determining is what exactly is CPI. So this is actually a cost average index of a number of price or the price of goods and services that people are using to pay, and this is all done via survey basis. So we're essentially looking at, and you can see here, 4,000 housing units and approximately 26,000 retail establishments across 87 urban areas. The purpose of CPI initially is that this was used to, or is still used to determine what we anticipate seeing the increasing cost of living, although it's not described as a cost of living index, but the impact of the increase of cost of living is associated with the day-to-day consumer. Now, as you can see, over time, the cost of living has continuously gone up, or at least the CPI. What we're looking at is how much is it going up on a year-by-year basis. So what I'm going to be looking at is the percentage change from 1 year ago. So this is why we think that it's super important. Again, there was an elevated time period during the 80s. This was when we saw incredibly high inflation, but we also saw incredibly high savings rates. So if we fast forward to today, we also saw during incredibly high monetary printing during the 2008-2009 financial crisis, there was a spike in CPI, and we are seeing that same spike now. So if we tone this down a little bit to be more representative of how did this compare with the last recession, you can see that we're closing in on the highs from 2008. The issue is, or the concern I have with tracking CPI, is that this is a metric that continuously changes in terms of what is being included in there. So we can't necessarily just drag this back through time and say that this is going to be a one-to-one relationship. The important thing to note here, though, is that as this continues to go up, we can anticipate that the 10-year yield will decline. So if we look at this, then you will see that we have the 10-year Treasury constant maturity rate. And you can see that we had the gap ups earlier this year, which is what caused that spike or that decline in shares. If we take this back over time, you can see that bond rates are actually very close to a historic low, with last year being that point in time. So what we're going to highlight here is, as we kind of dive into this, is that right now this is being artificially suppressed because the Federal Reserve and the Treasury are buying immense amounts or the Federal Reserve is buying immense amounts of treasury bonds. So that's keeping this price really from popping off at this point in time, because bonds used to be the huge indicator of not only inflation, but inflation fears. So the fact that these are being suppressed, you can actually see that even someone like Michael Burry has actually shorted the bond bull fund because they expect that bond rates are going to pop off. So if we're looking at this and trying to determine where we expect this to go, there is a lot of sentiment that we believe that this is actually going to be increasing. So if we expect inflation to be high, we can expect that really the next leg up from this is going to be that 2% level, 200 basis points that we saw coming into 2020. So we haven't even recovered back to where we were before the pandemic. So there's definitely room for this to run. And as they begin to talk about tapering, which I don't anticipate to happen this calendar year, but as they begin to talk about tapering, you can anticipate that this is going to essentially cause not only tech stocks to decline, but bond rates to continue to increase. Keep in mind that back in 2018, we were back closer to 3%, and historically, I would say that that is a lot more in line. What we have now is definitely more historic lows. So all of this being said, what does this mean? Right now, what I'm doing personally is I have some shorts out on some tech-based stocks. If you want to see how we talk about that, that is in the Discord down below. I list all my trades, and very often I talk about what I am doing in preparation for that. However, I'm keeping the positions small because at the same time that I have these inflation concerns, I think that the financial media is going to continue to push the narrative that this is not a problem, and in some cases, high inflation is actually good with consumers, which is a bold-faced lie. So we're going to be watching this. I've kept my position small, but at the same time, some of the key items that I think will be affected by inflation, will be affected by the decreasing value of the dollar, is going to be the oil prices. And as oil prices rise, that is going to benefit some industries and it's going to hurt other industries. So far, oil has been on the trajectory I've been talking about for the better part of the past 8 months, and I anticipate it'll continue to do so. For that reason, I'm looking right now long certain energy stocks and shorting certain high growth stocks for the near term. So that's what I'm looking to do. This is by no means financial advice because I'm not a financial advisor. I'm just some guy on YouTube talking about his opinion. So if you find that opinion helpful, please consider leaving a like and subscribe. And if you've made it this far, feel free to drop a comment down below asking any questions or join the Discord. Thanks for watching. Talk to you later.